Welcome to The Explainer. If you're looking to cut straight through the market noise, you're in the right place. Today, we're unpacking a massive contrarian call regarding the Federal Reserve and tech stocks. Look, right now, the market is absolutely terrified of looming rate hikes. But what if the broader consensus is just entirely wrong? What if the data is pointing to a completely different outcome? Well, we're going to break down exactly what the market is missing and how you can position yourself for what's coming next. Let's get into it.
To set the stage here, there's a quote from our source material that I absolutely love. Most of the time, Wall Street predictions are like gas station sushi. Might look good, but it's bad after about 15 minutes. It just perfectly captures the skeptical, highly analytical tone we need today. Wall Street is in a total panic right now over the Fed raising rates, predicting total economic doom and gloom. But swallowing that narrative without actually checking the underlying data, yeah, that might just leave you with a bad taste in your mouth.
And to prove why paying attention to this contrarian view is so incredibly valuable, check out this number, 115%. According to the source, by correctly anticipating the Fed's actual next move, there's a specific options trade strategy that could potentially hand you a 115% return in just about 6 weeks. That is the power of finding exactly where the market's wisdom is mispriced.
Okay, let's dive into the roadmap for today. First up, the Great Rate Shadow. Second, clues Wall Street missed. Third, the contrarian bond play. Fourth, a warning on NeoCloud and AI. And finally, rebalancing for safety. Starting off with part 1, the Great Rate Shadow and why the market is freaking out. Basically, the market is pricing in a really high chance of an upcoming rate hike, and everyone is terrified of a repeat of that brutal 2022 tech crash. Which brings us to the root of the issue, the Fed's true dual mandate. Their primary job is to keep inflation low, right? They target 2%. But the current personal consumption expenditures, or PCE, which is the Fed's preferred metric, recently hit 6%. At the exact same time, they have to protect the jobs market, which has slowed way down to an average of just 100,000 new jobs a month. The thing to remember here is that the Fed only cares about balancing these two specific metrics. They don't care about the stock market, they don't care about the deficit. So with inflation running hot at 6%, the market naturally assumes rate hikes are totally inevitable. Moving to part 2, clues Wall Street missed, the data hiding in plain sight. Because if you look past those panic-inducing headlines, there are massive clues showing that rate hikes are not coming nearly as soon or as heavily as everyone thinks. Just look at these statistics from the source. The biggest driver of inflation is energy, and crude oil recently plummeted a staggering 37% in just 6 weeks. Gas prices dropped 10% in a single month. This kind of energy deflation is absolutely going to show up in the upcoming data. Meanwhile, on the jobs front, only 57,000 jobs were added last month. That is a sharp decline. And worse, labor participation just hit a 50-year low as job seekers basically just give up. The bottom line here, the main drivers of inflation are cooling off rapidly, and the jobs market is undeniably weakening, which gives the Fed all the room they need to just pause on rate hikes.
On top of that, we have to consider the political realities. Historically, there's always political pressure on the Fed to keep rates low, which we've seen from leaders like former President Trump. But beyond the public tough talk on inflation from central bankers, the Fed actually just created 5 new internal task forces to review operations and policies, and those reviews, they take months. So practically speaking, this gives the Fed the perfect bureaucratic cover to hold off on any immediate or drastic rate moves.
So how does this actually play out? Well, you want to mark these exact dates on your calendar. July 14th brings the CPI report, which should start showing that energy inflation easing up. But July 29th, that's the real catalyst. That is the big Fed meeting where the source expects a massive surprise pause. No hike. Right after that, on July 30th, we get the PCE inflation report, followed by the next CPI report on August 12th. These are the specific windows where the broader market will finally realize the Fed is hitting the brakes, which is going to trigger some major movements. That brings us to part 3, the contrarian bond play, and exactly how to capitalize on this pause. To really grasp this, we need to remember a fundamental inverse relationship. As interest rates fall, or even just the expectation of rate hikes falls, bond prices go up. It's like a seesaw. When the broader market realizes the Fed won't be hiking as fast as everyone feared, bond prices are going to climb, and that directly drives up funds like the TLT, which is the 20-year Treasury ETF.
Now, the source outlines a highly specific option strategy to leverage this exact scenario. You start by buying the August 21st $85 TLT call options for $1.54.
To offset that cost, you sell the August 21st $87 TLT call options for 61 cents. That brings your net cost down to just 93 cents a share. If the TLT ends above $87, the spread is worth $2, securing that incredible 115% profit. But a massive warning here. Risk management is absolutely crucial. If the TLT drops below $85, this entire investment goes to zero. It's a highly calculated risk based on a very specific macro event.
And hey, while we're on the topic of smart financial maneuvering, the source makes a brief but vital point about idle cash. With traditional savings accounts paying a measly 0.38% on average, leaving your cash there means you are literally losing money to inflation. You've got to put that idle cash to work in FDIC-insured high-yield savings accounts like SoFi or Citibank, where you can earn up to 3.8%. It's a super simple, risk-free adjustment, but it can make a massive difference to your baseline returns.
All right, Part 4, Warning on NeoCloud and AI. How the Magnificent Seven is becoming the Lag Seven. Over $2 trillion has been wiped off tech valuations recently, and under the surface, these massive tech giants are rapidly turning from market leaders into a serious drag.
The current market narrative is honestly completely backwards right now. If we look at year-to-date performance, the ETF that actually excludes the biggest tech giants is up 15%. The broader tech-heavy Nasdaq is up 12%. But the ETF that holds strictly the Magnificent Seven tech stocks, it's down 5%. The largest, most popular tech companies in the world are quite literally dragging down overall tech performance right now. And within this tech landscape, there is a ticking time bomb, specifically in the neo-cloud sector. Think companies like CoreWeave or Oracle's cloud division. See, while big tech players like Meta or SpaceX are sitting on massive data centers and just renting out their excess capacity, the neo-clouds are borrowing heavily to build entirely new data centers to try and compete. The massive problem here is that the billions they are spending on hardware right now will be completely obsolete in just 2 years. Because they don't have the massive cash flows of big tech, our source warns that neo-clouds face an extremely high default risk. We could be looking at a massive wave of bankruptcies in about 24 months. We're also seeing intense volatility in AI hardware darlings like Supermicrocomputer or SMCI. The stock recently got hammered after reports surfaced that their offices were visited by authorities investigating illegal NVIDIA chip exports. While the source notes the stock is deeply undervalued right now, it is strictly a roller coaster play. It might be suitable for strategies like covered calls, but it is absolutely not for the faint of heart.
Which brings us to Part 5, Rebalancing for Safety. Let's take a look at exactly where the smart money is hiding out right now.
As we talk about rebalancing, I have to share this fantastic piece of advice from the source. The market has the emotional stability of a toddler after too much birthday cake. I mean, it's hilarious, but it's also incredibly true. You just cannot afford to panic sell based on initial knee-jerk market reactions. Take Nike, for example. They recently saw a massive drop pre-market on an earnings report, only to bounce right back up 5% by the close of trading, simply because their underlying fundamentals were solid. You've got to stay focused on the bigger picture.
And right now, that bigger picture is showing a massive capital rotation. During the first 6 months of the year, tech, energy, and cyclicals were the clear leading sectors, while healthcare, staples, and cybersecurity really lagged behind. But now, that is completely flipped. Capital is fleeing the high-flying tech and AI hardware sectors and rotating heavily into healthcare, consumer staples, and cybersecurity. Just look at the incredible rally in the cybersecurity sector. Palo Alto Networks shot up 23% in a single week. Companies like Zscaler, Fortinet, CrowdStrike, and Okta are all seeing huge momentum. Why? Well, industry experts are explicitly warning that companies literally only have a few months to prepare their defenses against a whole new wave of AI-driven hacking threats. So the smart money is moving exactly to where that immediate critical spending is going to be.
The proof of this rotation is pretty wild when you look at it. Campbell's Soup, which is arguably one of the most boring consumer staple stocks you can possibly imagine, is currently up 12%. Meanwhile, a flashy AI and tech ETF, the AIQ, is down 12%. It just proves that having some money parked in these boring, safe sectors really smooths out your ride, and it protects your capital when the tech sector decides to throw a tantrum. We've covered a tremendous amount of ground today. From the Fed's hidden rate shadow and the data proving they'll pause, to a highly leveraged contrarian bond trade, and the massive capital rotation out of AI and into safety. So I want to leave you with this final, provocative question. Based on everything we've looked at today, are you positioned to profit from the Fed's next surprise, or are you still following the toddler?
It's time to evaluate your portfolio, check your exposure, and let the data guide your next move. Thanks for joining me on this explainer, and keep learning.